Welcome. Today, we're diving into the fascinating world of exchange rates. Whether you're planning a trip abroad, shopping online from another country, or investing internationally, understanding exchange rates is crucial. These rates determine how much one currency is worth compared to another, impacting everything from travel budgets to global business deals. In this video, we'll break down what exchange rates are, why they matter, and how they affect your everyday life. Let's start by exploring the basics and setting the stage for a deeper understanding of this essential financial concept. Exchange rates are simply the price of one country's currency in terms of another. For example, if you're traveling from the US to Europe, you'll need to know how many US dollars equal 1 euro. These rates fluctuate constantly, influenced by a variety of economic factors. Understanding the basics of exchange rates helps you make informed decisions when exchanging money, shopping internationally, or investing abroad. Next, let's look at the different types of exchange rates you might encounter. There are two main types of exchange rates: fixed and floating. A fixed exchange rate is set and maintained by a country's government, while a floating exchange rate is determined by the market forces of supply and demand. Most major currencies like the US dollar and the euro use floating rates. Some countries, however, prefer to peg their currency to a stable one like the US dollar to maintain economic stability. Understanding these types helps you see why rates change and what influences them. Exchange rates are determined by several factors, including interest rates, inflation, and the overall economic health of a country. Central banks play a significant role by setting monetary policy and sometimes intervening in currency markets. When a country's economy is strong, its currency tends to appreciate, making it more valuable compared to others. Conversely, economic instability can lead to depreciation. Let's explore these factors in more detail to see how they shape the rates you see every day. Interest rates are a key driver of exchange rates. When a country raises its interest rates, it often attracts foreign investors looking for better returns. This increased demand for the country's currency can cause its value to rise. On the other hand, lower interest rates may lead to a weaker currency. Central banks carefully adjust interest rates to balance economic growth and currency stability. Next, let's see how inflation ties into this equation. Inflation, or the general rise in prices, also affects exchange rates. If a country has high inflation, its currency usually loses value because people can buy less with the same amount of money. Investors may avoid currencies from countries with high inflation, causing further depreciation. On the flip side, low and stable inflation tends to support a stronger currency. Understanding inflation's role helps explain why some currencies are more stable than others. Country's overall economic health is a major factor in determining its currency's value. Strong economies with low unemployment, steady growth, and sound fiscal policies tend to have stronger currencies. Investors are more likely to trust and invest in these countries, boosting demand for their currency. Conversely, economic instability, political turmoil, or high debt levels can scare off investors and weaken a currency. Let's look at some real-world examples to see this in action. US dollar is one of the world's most traded currencies. Its value is influenced by the strength of the US economy, interest rates set by the Federal Reserve, and global demand. When the US economy is booming, the dollar often strengthens. During times of uncertainty, investors flock to the dollar as a safe haven, further increasing its value. This example shows how economic factors and investor confidence shape exchange rates in the real world. Euro is another major global currency. Its value is influenced by the economic health of the Eurozone, including countries like Germany, France, and Italy. Political events, economic data, and decisions by the European Central Bank all play a role. When the Eurozone economy is strong and stable, the euro tends to appreciate. However, crises or disagreements among member countries can cause the euro to weaken. This highlights the complexity of exchange rates in a multi-country currency. Exchange rates are typically quoted as currency pairs, such as USD/EUR or GBP/JPY. The first currency is called the base currency, and the second is the quote currency. The rate tells you how much of the quote currency you need to buy one unit of the base currency. Understanding currency pairs is essential for travelers, investors, and anyone dealing with international transactions. Let's see how to read and interpret these pairs in practice. You see a currency quote like USD/EUR equals 0.9, it means 1 US dollar equals 0.9 euros. If the number goes up, the base currency is getting stronger. If it goes down, it's getting weaker. This simple format helps you quickly compare the value of different currencies. Next, we'll look at how these rates are used in real-life situations, from travel to online shopping. You travel abroad, exchange rates directly affect your spending power. A strong home currency means your money goes further, while a weak one means you'll pay more for goods and services. It's important to check the latest rates before your trip and consider using credit cards that offer favorable exchange rates. Being aware of these changes can help you budget more effectively and avoid surprises. Shopping online from international retailers often means dealing with exchange rates. The price you see may be in a different currency, and your bank or credit card company will convert it at the current rate, sometimes adding a fee. Understanding how these conversions work can help you find the best deals and avoid unexpected costs. Always check for additional charges and compare rates before making a purchase. Investing in foreign stocks or bonds exposes you to exchange rate risk. If the currency of your investment weakens against your home currency, your returns may decrease, even if the investment itself performs well. On the other hand, a strengthening foreign currency can boost your returns. Understanding this risk is crucial for making informed investment decisions and managing your portfolio effectively. Businesses that trade internationally must closely monitor exchange rates. Fluctuations can impact profits, pricing, and competitiveness. Companies often use strategies like hedging to protect themselves from unfavorable rate movements. By locking in exchange rates for future transactions, they can reduce uncertainty and plan more effectively. Let's see how businesses manage these risks in practice. Hedging is a common strategy businesses use to protect against exchange rate fluctuations. By entering into contracts that fix the exchange rate for future transactions, companies can avoid unexpected losses. This is especially important for exporters and importers dealing with large sums of money. Hedging provides stability and helps businesses focus on their core operations without worrying about currency swing. Central banks sometimes intervene in currency markets to influence exchange rates. They may buy or sell their own currency to stabilize its value or achieve economic goals. These interventions can have a significant impact on global markets, especially when major economies are involved. Understanding central bank actions helps explain sudden changes in exchange rates and their broader effects. Currency markets are among the largest and most liquid in the world. Traders and investors often speculate on exchange rate movements, hoping to profit from changes in value. This speculation can increase volatility and lead to rapid shifts in rates. While speculation can create opportunities, it also adds risk and unpredictability to the market. Exchange rates can be highly volatile, changing rapidly in response to news, economic data, or geopolitical events. This volatility can create challenges for travelers, businesses, and investors. Understanding the causes of volatility and how to manage it is key to navigating the world of currency exchange with confidence. Political events such as elections, policy changes, or international conflicts can have a major impact on exchange rates. Uncertainty or instability often leads to currency depreciation, while positive developments can boost confidence and strengthen a currency. Staying informed about global events helps you anticipate and respond to changes in exchange rates. Geopolitical tensions, such as trade wars or military conflicts, can create uncertainty in currency markets. Investors may move their money to safer currencies, causing rapid shifts in exchange rates. Understanding the link between global events and currency movements can help you make better financial decisions in uncertain times. Some currencies like the US dollar, Swiss franc, and Japanese yen are considered safe havens. During times of global uncertainty, investors flock to these currencies for stability. This increased demand can cause their value to rise, even if their home economies are not especially strong at the time. Knowing which currencies are safe havens can help you protect your assets during market turmoil. Emerging market currencies often experience greater volatility than those from developed countries. Factors like political instability, economic growth, and external debt can cause rapid changes in value. While these currencies can offer higher returns, they also come with increased risk. Investors should carefully weigh the potential rewards against the risks when dealing with emerging market currencies. Currency crisis occurs when a country's currency rapidly loses value, often due to economic mismanagement, political instability, or external shocks. These crises can lead to inflation, loss of savings, and economic hardship. Understanding the warning signs of a currency crisis can help you protect your finances and make informed decisions during turbulent times. Countries choose different exchange rate regimes based on their economic goals. Some prefer fixed rates for stability, while others opt for floating rates to allow market forces to determine value. There are also hybrid systems that combine elements of both. Understanding these regimes helps explain why currencies behave differently around the world. Technology has revolutionized the way we exchange currencies. Online platforms and mobile apps make it easy to check rates, transfer money, and even trade currencies from anywhere in the world. This increased accessibility has made currency exchange more convenient, but it also means rates can change even faster than before. Staying up to date with technology can help you get the best rates and avoid pitfalls. Cryptocurrencies like Bitcoin and Ethereum have introduced a new dimension to exchange rates. Their values are highly volatile and not tied to any government or central bank. While they offer opportunities for profit, they also carry significant risks. Understanding how cryptocurrencies interact with traditional currencies can help you navigate this rapidly evolving landscape. Exchange rate calculators are handy tools for travelers, shoppers, and investors. They quickly convert one currency to another using the latest rates, helping you make informed decisions. Many calculators are available online or as mobile apps, making it easy to check rates on the go. Using these tools can save you time and money. Currency exchange services such as banks, airports, and online platforms offer different rates and fees. It's important to compare options to get the best deal. Some services charge higher fees or offer less favorable rates, so always check before exchanging money. Being informed helps you maximize the value of your currency. Hidden fees can eat into your money when exchanging currencies. These may include service charges, poor exchange rates, or additional transaction fees. Always read the fine print and ask about any extra costs before making a transaction. Knowing what to look for can help you avoid unpleasant surprises and keep more of your money. Millions of people send money across borders to support family or friends. Exchange rates play a big role in how much money the recipient actually gets. Even small changes in rates can make a difference, especially for large or frequent transfers. Comparing rates and fees among different remittance services can help you send more money home. Tourism is heavily influenced by exchange rates. When a country's currency is weak, it becomes a more attractive destination for foreign visitors as their money goes further. Conversely, a strong currency can make travel more expensive for tourists. Understanding these dynamics can help you choose the best time and place for your next vacation. Studying abroad is a dream for many, but exchange rates can significantly impact the cost. Tuition, living expenses, and travel costs all depend on the value of your home currency compared to the destination country. Monitoring rates and planning ahead can help you budget more effectively and make your education abroad more affordable. International students often face challenges due to fluctuating exchange rates. Changes in currency value can affect tuition payments, rent, and daily expenses. Staying informed about rate trends and using tools like forward contracts can help students manage costs and avoid financial stress during their studies. Buying property abroad is increasingly popular, but exchange rates can make a big difference in the final price. A favorable rate can save you thousands, while an unfavorable one can add significant costs. It's wise to monitor rates, consult experts, and consider hedging options when making large international purchases. International trade relies heavily on exchange rates. Exporters and importers must constantly monitor currency values to price goods competitively and protect profits. Sudden changes in rates can impact supply chains, contracts, and overall business performance. Understanding these dynamics is essential for anyone involved in global commerce. Exchange rates can influence job markets, especially in export-driven industries. A weaker currency can boost exports and create jobs, while a stronger currency may make exports less competitive and lead to job losses. Understanding this relationship helps explain why governments and businesses pay close attention to currency movements. Exchange rates and inflation are closely linked. A weaker currency can make imports more expensive, leading to higher inflation. Conversely, a stronger currency can help keep inflation in check by making imports cheaper. Understanding this connection is important for managing personal finances and making informed economic decisions. Governments use various policies to influence exchange rates, such as adjusting interest rates, intervening in currency markets, or implementing trade controls. These actions can have far-reaching effects on the economy, businesses, and individuals. Staying informed about government policy helps you anticipate changes in exchange rates and plan accordingly. Globalization has increased the importance of exchange rates in our daily lives. As businesses, travelers, and investors operate across borders, currency values play a bigger role in shaping economic outcomes. Understanding exchange rates is now essential for anyone participating in the global economy. Exchange rates can impact your personal finances in many ways, from the cost of imported goods to the value of your investments. Being aware of rate trends and planning accordingly can help you save money, avoid losses, and make smarter financial decisions. Let's review some tips for managing your finances in a world of changing exchange rates. To get the best exchange rate, always compare options, avoid exchanging money at airports, and use credit cards with no foreign transaction fees when possible. Online tools and apps can help you track rates and find the best deals. Being proactive and informed can save you money and make your international transactions smoother. Many people make mistakes when dealing with exchange rates, such as not checking the latest rates, ignoring fees, or exchanging too much money at once. Avoiding these pitfalls can help you keep more of your money and avoid unnecessary losses. Always stay informed and plan ahead for the best results. The world of exchange rates is constantly evolving. Advances in technology, changes in global trade, and new financial products are shaping the future of currency exchange. Staying informed about these trends can help you adapt and make the most of opportunities in the global economy. Congratulations, you've now gained a comprehensive understanding of exchange rates and their impact on your life. From travel and shopping to investing in business, exchange rates play a crucial role in the global economy. By staying informed and making smart choices, you can navigate currency changes with confidence and make the most of your money, no matter where you are in the world.